Hi everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and today's market updates. Today my stock account has gained $215.78, which is a gain of 0.31%. Right now the net asset of my account is $69,812.74. Today Apple has closed up 0.08% to 198.11, and SQQ has closed up 0.49% to 14.41, and S&P 500 closed up 0.32%. United Natural Gas closed up 3.48%. Dow Jones Industrial Average closed up 0.43%. Nasdaq closed up 0.19%, and S&P 500 closed up 0.26%. Today, the auto industries and the financial industries all closed with a gain of more than 2%, whereas the healthcare and software infrastructures closed down with a loss of more than around 2%. And today, let's talk about the recent Fed decision and the response from the ECB. At a press conference on Thursday, after the ECB's rate decision was announced, ECB President Christine Lagarde said he should not be relaxed and be pleasant about the recent cooling of inflation, and that the ECB has not discussed a rate cut at all. The ECB's decision action depends on the data, not on the timing. Ms. Lagarde's comments were similar to the Bank of England on the same day, in sharp contrast with yesterday's Fed Chairman Colin Powell. While Mr. Powell remained cautious, refusing to declare victory against inflation and saying the Fed would not rule out further higher interest rates when appropriate, he also sent a new blockbuster, long-awaited incremental message that the Fed's meeting has begun to discuss the cut. Lagarde weighed on market expectations of a rate cut, as traders cut their bets on the outlook for the ECB to cut rates, with the latest estimate of less than 150 basis points in 2024, down from the previous 160 basis points. The euro rose 0.9% against the dollar to a new daily high of 1.0978, while the 2-year German bond yield rose more than 10 basis points to a new daily high of 2.567%. Ms. Lagarde said the ECB's firm commitment to keep inflation back to the 2% in timing still needed to work on inflation in the Eurozone. It has stood stubborn in many European regions, such as South Europe. More data is needed to assess whether Eurozone inflation is stubborn, and the ECB will have plenty of data in the first half of 2024. She spoke specifically about the salary issue, which data are needed to judge inflation more clearly, she said. According to the available data, the wage pressure has not fallen, but she also noted that tighter financing conditions will drag down the economy, and that a weakening economy would dampen demand for labor. Ms. Lagarde expects inflation to pick up in December due to the base effect, where the interest rate of cooling inflation will slow in 2024. Upside risks to inflation include geopolitics, ongoing wage negotiations, and corporate profits, while downside risks to inflation included an economic slowdown. Ms. Lagarde said risks to growth in the Eurozone remain tilted to the downside, including geopolitics and global economic weakness, but she was not very pessimistic, saying that there is no evidence of a sustained decline in the Eurozone economy, not expecting a recession in the Eurozone, and that the current labor market continues to support the economy. Ms. Lagarde says the market interest rate have fallen significantly, and the outlook for financial stability remain fragile. The ECB policymakers generally unanimously expect the rate cuts to be later than financial markets have expected, citing officials familiar with the ECB policymakers for their ideas. The ECB said that it'll stop PEPP reinvestment by the end of 2024, continue the PEPP reinvestment of 2024 in the first half of 2024, and in the second half of the year, we plan to exit the PEPP reinvestment plan at an average rate of 7.5 billion euros per month. Lagarde explained that the decision of the PEPP reinvestment has nothing to do with the interest rate decision of the ECB. Interest rate is the main tool, and they have declared to use it independent of PEPP. She also said the Eurozone needs to advance to new fiscal rules and more quickly agree on reforms to the European fiscal framework. Fiscal policy should improve the productivity of the economy. It should reduce public debt and make faster progress in structural reforms to improve the competitiveness of the Eurozone. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.